Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Brian Stutland, Chief Investment Officer, Equity Armor Investments, to discuss what options activity is indicating relative to the trading that we're seeing in the Nasdaq-100. Brian, it's great to see you as always. Welcome back to Trade Talks. And what are you looking at in the options market, and what does it suggest for what you're seeing in the Nasdaq-100?
Well, when you look at some of the growth names out there and the tech names that have just gotten battered down, a Tesla and Amazon, a lot of those consumer discretionary type names, that downside risk has been tremendous for those stocks. And yet option premium out there really isn't reflecting that, meaning it's been pretty cheap to be able to buy a put relative to the amount of moves we're seeing. We get a 3% move today on the Nasdaq. I would expect something like a vol Q, which measures the value of those options on the Nasdaq 100, to be well above 40 on a day like today. And we're not seeing that. To me, that says option traders are comfortable getting long this market somewhere, let's call it 10,000 on the Nasdaq. But to me, it doesn't make sense. The risk, like I said, that we're seeing in like names like Tesla and Amazon on the downside, to me, determines that there should be a lot more risk premium put in the options market right now.
So does that mean traders are complacent, or do they think that this valuation reset, this is the bottom here, is somewhat capitulated? What does that mean?
I think it is saying that they're a little complacent, like you said, Jill, here, because I would expect, again, like something like a vol Q over 40 right now. And maybe it takes a little time for this whole system, this whole play out of a rising rate environment to sort of hit the rest of the market. And, typically that has been the case. When we've seen the 3-month treasury get significantly above the 10-year and there's that steep negative yield curve, it does take some time for the volatility event to occur. And so maybe we're just not quite ready for that type of volatility event. But call it 6 months from now or something, it's on the horizon. We can't be sustained in this type of market environment that we're in and just, be complacent about the downside.
Yeah, and Brian, you've been consistent with your messaging. Perhaps that capitulation event has to do with earnings, right? Because we have not seen them based, right? We haven't seen analysts bring their projections in, and Q4 earnings, which are coming out in the next 4 weeks, could in fact be challenging. And perhaps we shift from that macro narrative to a little bit more fundamental, because earnings are going to come into play at some point.
Right. Yeah. I mean, that's definitely true. I mean, as we see this rising interest rate environment, the Fed seems very well determined they're going to go over 5% next year based on what, Powell talked about yesterday. And so if that happens, it does feel like the earnings have to come down. And then all of a sudden now people are using the word recession. And then all of a sudden we start to get some deterioration possibly in the credit markets. That's what sort of held the market up so well as it has, is that the credit markets really haven't felt the impact of all this. We get some negative earnings, the credit markets will feel that. We'll probably get a volatility event at that point.
Yeah, I mean, you have to think about balance sheet deterioration as well. We're seeing it now, right? We're seeing cash being drawn down. It's not like the debt markets are as easily accessible. So it's going to be challenging here for companies to, maintain a better capital position, if you will. And I don't feel like it almost feels like there's a disconnect, right? The market wants one thing, right? And Powell's not going to pivot his strategy based on what the market wants. Meanwhile, he's out there saying we're looking at a rate of 5 to 5.1%, and it just seems as if the market just doesn't want it, and it's not following what he's saying, if that makes any sense.
Right. If the market's not going to follow what he says, he's going to eventually crack the market because, like I said, that steep negative yield eventually trickles through. We've seen historical volatility events occur about 12 to 18 months after that negative yield starts to occur in the very short-term rates versus long-term rates. So maybe it just takes a little while for that to trickle effect and wind down. I would be looking at names, that we own for our fund, obviously, Apple, Microsoft, Google. Those are 3 basically staples, which I almost call the value portion of tech these days. And look at those names, see how that earnings picture draws out in the next month, because if there's some negative guidance there, that could create that volatility event that we're talking about.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.